The high net worth portfolio spans 5 allocations: equities, fixed income, real estate, commodities, and alternatives. But most investors make a critical mental accounting error. They isolate life insurance into a separate budget category, evaluating it as a recurring administrative cost.
By the way, don't forget to subscribe to the channel and click the bell icon for notifications to get the latest video updates so I can share more tips and strategies with you to increase your overall sales. By the way,
this traditional framing creates a structural vulnerability. Insurance requires the exact same analytical rigor, risk-adjusted calculation, and correlation analysis as any other alternative allocation. It belongs directly inside the core portfolio matrix. Treating it as a sunk cost rather than an investable asset leaves a defensive gap in the portfolio's architecture. This matrix defines the strict criteria of an asset class. To qualify, an investment must possess specific consistent characteristics regarding its risk, return, liquidity, and correlation. The core physics of portfolio construction dictate that the greater the non-correlation to existing holdings, the higher the diversification benefit. Traditional asset classes are often tethered to the same global economic cycles, interest rate fluctuations, and credit spreads. The return profile of an insurance contract is divorced from these market forces. It relies on actuarial mathematics, health underwriting data, and human longevity. Because its drivers ignore global financial markets, insurance provides the portfolio with a zero correlation anchor. The first defining characteristic of this asset class is its trigger mechanism. Stocks compound, real estate generates yield, and private equity matures only while the investor is alive and actively holding them. This timeline tracks standard market returns against an insurance asset. While traditional markets fluctuate, the insurance line remains flat until the exact moment the portfolio's primary decision maker and income generator is removed, at which point it triggers maximum vertical yield. This is a strict mathematical hedge against the sudden loss of human capital by operating on direct anti-correlation to the investor's survival. It generates liquidity exactly when the family's financial vulnerability is at its peak. The second characteristic is structural tax deferral, specifically utilizing structures like private placement, life insurance, or PPLI. This chart models a 30-year compounding cycle. On the left, continuous tax drag slices away potential growth from standard equities. On the right, the PPLI structure preserves the entire pre-tax base, allowing capital to compound without interruption. When capital is needed, accessing liquidity via policy loans is non-taxable, leaving the entire base intact to continue compounding. The third characteristic establishes a guaranteed mathematical floor on the downside. Capturing long-term equity premiums requires absorbing multi-year market drawdowns. Watch the behavior during a contraction. While the broader portfolio collapses, the insurance's cash value acts as a hard floor backed by regulatory requirements. It simply does not decline. Securing this unyielding baseline means the remainder of the overall portfolio can be allocated toward aggressive, high-growth assets without exposing the total architecture to ruin. The fourth characteristic acts as a pre-approved structural liquidity bridge for the broader portfolio. When a distressed market opportunity arises or a private equity capital hits, this diagram demonstrates the capital flow. Instead of liquidating locked assets at a discount, policy loans route capital directly from the insurance facility to the target. The fifth characteristic guarantees intergenerational transfer at a contracted value. This graph maps two distinct wealth transfer outcomes. A standard inheritance gives heirs whatever the market dictates on the day of administration. The insurance transfer delivers a precise contracted payout, regardless of the current market cycle. This mechanism bypasses the probate process, delivering capital directly to beneficiaries on the insured's strict timeline by removing market volatility from the moment of death. These mechanics eliminate sequence of returns risk for heirs. Progressive wealth utilization pyramid illustrates how the sixth asset class scales. At the base, the protection foundation uses term and whole life to guarantee continuity. At the structuring level, PPLI wrappers add tax efficiency. At the top institutional tier, premium financing turns the allocation into the core estate engine, but leverage requires precision. Premium financing is only viable when stress testing proves that the net spread between the policy's internal return and the loan's cost remains positive across downside scenarios. Whether acting as a foundational safety net or a leveraged institutional mandate, the asset class scales to fulfill the structural demands of the total portfolio. The industry managing this asset class is undergoing a rapid technological upgrade. Traditional underwriting, historically reliant on slow medical exams, is being supplemented by AI-driven analysis. Actuaries now integrate modern data sources, biometric volatility tracked by wearable health monitors, vehicle telematics, and digital footprints. This granular risk segmentation allows high net worth investors to secure large policy limits with more efficient pricing and faster underwriting timelines. This digital integration converts the insurance contract into a dynamic component of the portfolio, responsive to real-time health data and compressed market timelines. Beyond its return and liquidity characteristics, this asset class possesses a distinct legal advantage: statutory creditor protection. In most global jurisdictions, both accumulated cash values and named beneficiary death benefits are legally shielded from business failure and commercial litigation. This is a deliberate legislative feature designed to ensure that a family's financial survival takes priority over the claims of business creditors. Maximum protection is achieved when policies are housed within irrevocable trust structures, legally removing the capital from the grantor's estate. Omitting this layer of asset protection leaves high exposure professionals and business owners exposed to total capital wipes during periods of commercial distress. A traditional 5-asset portfolio forces equities and alternatives to manage continuity risks they were not engineered to handle. The 6th asset class functions as a tax-deferred growth engine, a downside floor, a non-taxable liquidity facility, and a guaranteed estate transfer instrument simultaneously. The integration of insurance as a core allocation provides the structural defense that equities, debt, and alternatives cannot generate on their own.